Good morning. Welcome to episode 4 in an 8-part series to the Get Rich Slow podcast. I am your host, Rob Delavan. Adrian Shermer, our normal host, is in Hawaii. And Lance Johnson is back to back with clients today. So I am joined, and you're welcome. You guys don't have to listen to me talk for 15 or 20 minutes. I'm joined by Sue Yort of ROI Tax. So
Hello.
Welcome.
Thank you. Thank you.
And welcome back, the Get Rich Slow podcast. So this is, again, episode 4 in an 8-part series. The title today is The Basics of Small Business Taxes. Exciting stuff, especially for me, at least, since I'm the owner of a couple or a few different small businesses. I want to share a success story with you guys today. And this has been an ongoing thing year after year, but that Sue has helped me as a small business client of hers, help planning when to buy vehicles. So I don't want to go into the nitty gritty too much, but section 179 of the IRS tax code, which we can link to the comments down below, basically states that within certain situations, if I'm with certain criteria met, and we won't go into it, but a real estate broker or real estate brokerage or a contracting company can utilize a 1-year accelerated depreciation write-off of work vehicles. And the last few years, we've been planning on when I buy work vehicles, and that has reduced tax liability and allowed us to, frankly, provide more work vehicles for our operations. So thank you, Sue.
You're welcome.
If I can save on taxes to invest in a business, I mean, I believe that's the reason why.
That's a win.
That was put in. It's all day long, every day, and I'll do it year after year after year. So thank you for that success. Upcoming events, we will link to our calendar of events for the entire year on our websites. And we have the ROI-tax.com website for Sue, Delavan-realty.com, myself. And then we have Adrian's at Directors Mortgage and ROI-financial.com, -financial. Also, and everything will be in the show notes at the bottom, but go there if you'd like more information. For the episode ahead, Sue, again, is going to be our the big brain that we're going to mine, and she'll be teaching us the basics regarding some small business taxes and frequently asked questions, again, in an 8-part series. In the last episode, episode 3, we learned what to expect in 2022 when it comes to your taxes. So, Sue, you've only been doing this for what? How many decades? Going on your third?
Yeah, I'm in my third decade. Yes.
She's with ROI Tax. And we always are lucky and blessed to have you, especially given that this is February of 2022. So we're already into tax season. We will take everything we can get from you. And thank you for graciously sharing your time with us.
You bet.
So as our trusted CPA, let's just jump into question number 1. So what's the difference between an LLC and an S Corp? And when should you make the switch? And of course, I'm sure there's some benefits, one or the other. And this is small business taxes 101.
Yes, it is. And I get asked that question by every small business owner. So This is an important one. Mm-hmm. Okay. So there's some basic similarities. I mean, an LLC and an S Corp do not pay their own taxes. They may have their own tax return, but any net income or loss from an LLC or an S Corp passes through to the personal owner's tax return. Right. So if it's 50-50 owned or, 3-way owned, however it is, it gets passed through in those percentages. Okay. Those are the similarities. But the big difference is if you have an LLC, it acts like a partnership. An
Mhm.
LLC is a limited liability corporation. And with a partnership, if you have income, you don't have wages in an LLC for the owners,
Mhm.
passes through to the owner's return, and they not only pay ordinary income tax, but they have to pay their own self-employment tax
Right.
on their personal tax return. So as you can imagine, when you're earning a net income of 10,000 on your personal tax return, that's doable. You know, you got ordinary income
Right.
tax. Yeah. But the self-employment tax, you're paying the employer half and the employee half. So that's 15.2%. Okay.
Okay.
0.3. Sorry, I need
Mm.
to think better. So as those people are going up, you know, 20,000, 30,000, you know, 50,000, 100,000,
Mhm.
when they're getting over 50,000 consistently as their net income, and say
Mhm.
there's only one owner, so that whole amount's going on their tax return,
Mhm.
and 15.3% of it is additional tax that they have to pay. That's when I'm talking to them. Between 50 and 100,000 is when I say time to do an S corp.
Okay.
Now on an S corp, the owner has to take wages, and
Mhm.
then any remaining net income goes onto their personal tax return. Like I
Mm.
said, passes through. However, there's ordinary tax on it, but no self-employment tax. If they've
Mm.
already taken, so we'll go with that 50,000, they took 20,000 as wages. The payroll taxes on that is paid through the business. The 20,000 does go as wages on their personal tax return. The
Mhm.
remaining 30,000 is net income, so ordinary income tax, but no more self-employment tax, and not two sides of it. So this is the benefit. I mean, I'm saving people 6,000, 12,000, you know, $20,000 by
Mhm.
not paying self-employment tax.
And that's a big, I would say that's a big like pivot point for somebody's business, because it starts to go from maybe like more of a hobby side business to, okay, this thing is humming along and it's making 100,000, you know,
Yes.
and that's, like you said, the net income.
Yeah, you're
Um,
legit. I mean,
right.
this is a business, and we're not talking about, okay, you've lost money 5 years, the IRS is gonna think it's a hobby, go away. No,
Right.
you're going up the ladder and you're
Mhm.
making it work, and it's a business. We need
Okay.
to, you know, do some tax planning.
Okay. And that's, I mean, obviously that's been a big drumbeat for this entire series. Is this is where we start really diving into the benefits of an actual consultative tax approach,
Mhm.
where we're planning and being strategic ahead of time rather than just reacting to whatever was the status quo before. So
Yeah,
and would you say this is when you start having this conversation, this is where you start doing tax planning, like during July and other
proactively.
times of the year too? Um,
Absolutely, because it usually happens when, you know, they had 20,000 of net income one year,
mhm.
and then the next year they had 75 of net income, and they're like, my taxes are ridiculously high, you
Right,
know, and I'm like, now is when you need to be
right,
an S corp. They're only going to get bigger. So yes,
right.
we do proactive. I'm looking at their books throughout the year. We're
Mhm.
making planning for retirement, all kinds of things. So
Because what gets hairy is if, oh no, I just realized, December 15th that I made triple what I made last year. It gets much more difficult to switch, and even at that point, even though it's before the end of the year, it's basically impossible. Like you really have to do it for the next year, right?
yes.
Yeah.
I
So
would really rather do it that way because there's a lot more we can do if we start planning in March or
right.
May, as
Sure.
opposed to, yeah, December 15th, all we can
Okay.
do is kind of put a Band-Aid on it and say,
Right.
put some into a SEP IRA. But
Right. Okay.
let's talk about in May, getting you an S
Mm,
corp, putting you on salary, maybe a 401k, you know,
okay.
some bigger things.
Excellent. Okay. That's great advice. Okay. So my next question is, what is a Schedule C and why is it important? And we will put the definition of a Schedule C, just the basic one with references in our show notes.
Okay, so a Schedule C is where you start if you're a sole proprietor, you have an idea for a business, you'd like to give it a try, but you don't want to overcommit.
Right.
Okay, I mean, maybe you become an LLC just to give you that layer of protection. An LLC stands for Limited Liability Corporation. It doesn't mean you're a corporation. It doesn't mean you have to pay wages. It just means, hey, I've got a little legal protection, so I'm protecting my other assets from this newly formed entity. So it could be that hobby that you've decided to take a little further than that. Hey, I'm selling some things to people. What do I need to do?
Right.
Or it could be that Amway or some type of business where I'm giving this a try. I'm really liking it. Do I need to be an S Corp? No, not yet. I like to tell people to start as a sole proprietor or an LLC where you're just got a layer of protection. And then I tell them, we'll see how it's going in 3 to 5 years. And if it's taking off, that's when I take it to the next level of an S Corp, that type of thing. But it's necessary for those things where you're making, you're making some money. They like to call them cottage industries sometimes, where you're doing it out of your home when you first start. I mean, remember, Nike started in a garage.
Right.
So
and a waffle iron, right?
That's right. Absolutely. So that's why they call them cottage industries.
Right. Okay.
Yeah. So that's what it's for. And we've got a little reference in the notes to a website called thebalance.com, and it will give some more information about Schedule Cs.
Okay, great. So last question for today. This is a hot button. You've helped me with this significantly over the years. Yes. When is it best to hire a 1099 contractor versus a W-2 employee? And we might want to start with defining those terms, which we'll throw in the show notes.
Absolutely. Okay. So a 1099 contractor is your business is growing. You need a little help, but you don't need somebody full-time. You just need, okay, this person, you're selling stuff on Amazon or Etsy or something like that. You need somebody to come in and box it up and take it to the post office and ship it, once a week, maybe something like that. Right. So that's a contractor where you say, hey, your neighbor's a teenager or something. I will pay you $20 an hour to just come over and do this. And it'll probably be about 4 or 5 hours a week or whatever it is. That's a contractor, but it can even be a part-time person. Okay, you've got a moving company. I mean, that's small and starting. Okay, I just need a driver a couple days a week. Sure. And so 1099 contractors you're paying them an hourly rate, but you're not withholding any taxes for them. So that's how it saves money for the business, by not having to pay the employer side of the taxes. Sure. However, the biggest piece about contractors is they kind of come and go as they please. Right. It's not like they have a permanent place in your organization, and they have another job. They could not be making a full-time wage doing what the hours you're asking them, something like that. Or it's someone with a business that's like, hey, I do tile, but I need somebody to do this piecemeal work down here that I can't do. And so they just have somebody come in and do that, and off they go. Right. They've got another business. Okay.
So there's a litmus test there. I think some of the questions that I've been asked about that by you actually was, are you telling them like what to do, when to do it, how to do it? Are you furnishing them in a chair? Like there's a number of questions where, and if you start answering yes on all of those, it's like, they're an employee. So
Bingo.
Yeah.
Those are all what I've asked you and all what someone needs to ask themselves. And even on the Oregon Department of Revenue website, I think even on the IRS website, there's like 10 to 12 questions that you ask.
Okay.
And those are the exact things. It's a W-2 employee. If, you provide them with a place to work, you tell them what time to come and go, you train them or provide them, this is what I want you to do. Those type of things. Because even part-time people can be employees if all those things are met.
Well, there's an interesting nuance here is in the pandemic world, everybody went to remote, right? And which then just by definition started to make it, well, there's less telling them when to do it, right? So I am aware of a bit of a trend. Usually over the last years, it's been converting more and more people from that contractor role to employee role. And then just in the last couple of years of the pandemic, there has been a little bit of direction the other way, at least just from a social aspect, I guess, like a social norm.
Exactly. I mean, there's going to be a few more contractors because you aren't following some of those rules, like, okay, they log in when they want, and maybe as soon as their work's done, they can log off and that type of thing. However, I mean, if, you can have flex time and still be an employee. Like, for example, some employers have said, okay, we want you to come back, and there's been to an office, and there's been pushback. So they said, you can be hybrid. So maybe they spend 3 days a week at home, but their employer tells them you have to be in the office 2 days a week. Or there are some employers that say you have to be online these hours of the day because that's when we have Zoom meetings, or I need you available to your boss, or those type of things. Okay. So you can still be remote worker and be an employee, but yes, I can definitely tell you there's gonna be, some range of contractors.
Okay. So Sue, any final thoughts? 15 seconds or less, small business taxes. Good luck. 15 seconds.
And I wouldn't say good luck. I'd say if you're starting a small business, you need to see a professional, because there's a lot more out there than you know about.
Yeah. Okay. That's huge. I can personally attest to that. Thank you so much for being here, Sue. Again, the value of especially during tax season, being able to provide this to our audience is incredible.
You're welcome.
The best way to find Sue is visit her at her website, www.roi-tax.com. That'll be linked below in the show notes. And please stay tuned for our next episode in this 8-part series with Sue. The next episode will be learning how to make standard deductions versus itemized deductions simple for you. So again, very exciting. Oh, I love it. Thank you so much for listening to the Get Rich Slow podcast, and we'll see you guys next time.